You've worked hard and saved carefully for retirement. But what many Canadians don't realize is that the way you withdraw your savings could leave you paying far more tax than necessary. It's not uncommon for retirees to be blindsided by clawbacks on government benefits, larger than expected tax bills, or penalties they didn't even know existed. The good news, with a bit of planning, you can avoid these traps and make sure more of your hard-earned savings stays in your pocket. Hi, if you're new here, my name is Scott McCartney, and I'm a portfolio manager from Novus Pro of Raymond James. What do? I help families and individuals navigate an increasingly complex and volatile investment environment by developing customized financial plans that turn technical knowledge into practical, actionable strategies. In this video today, we're going to break down 3 hidden tax traps that can quietly erode your retirement income, and more importantly, how to sidestep them. Here's part 1. Why retirement taxes can catch you off guard. A lot of Canadians assume their tax burden will drop as soon as they stop working. It makes sense, right? Without a salary, shouldn't your taxable income go down or decrease? But here's where retirement gets a bit tricky. Your income often comes from multiple sources, such as CPP and OAS payments, RSP or RRIF withdrawals, non-registered investment income, and maybe even some part-time work or rental income. When these income streams all combine, they can do several things. They can push you into a higher tax bracket, for one. They can trigger clawbacks on your government benefits, or they can result in tax surprises that you weren't expecting. So let's look at the first major trap. Part 2, tax trap number 1, the OAS clawback. Old Age Security or OAS provides a modest monthly payment to most retirees. But there's a catch. If your net income exceeds a certain threshold, the government claws back a portion of your OAS. For 2025, by the way, the clawback begins at around $90,997 of net income. Beyond that, you lose 15 cents of OAS for every extra dollar that you earn. So here's a real life example. Let's take Marie, a 68-year-old retiree in Mississauga. She needed to replace her roof and withdrew an extra $35,000 from her RRSP in order to pay for it. That one-time withdrawal pushed her income to $102,000, which triggered the old Age Security Clawback and reduced her benefits by nearly $1,600 the following year. To make matters worse, the higher income nudged her into the next tax bracket, meaning she paid more tax on every extra dollar. Here's how to avoid it. Number 1. Plan RSP withdrawals carefully before age 71 to spread taxable income over more years. 2. Use TFSAs for tax-free growth and withdrawals. They don't count towards your net income. 3. Consider income splitting with your spouse to balance taxable income between you. Part 3, tax trap number 2, RSP to RRIF conversion shock. So by December 31st of the year you turn 71, you must convert your RSP into an RRIF and start mandatory withdrawals the following year. So here's the issue. Those withdrawals are taxable income, and they can be surprisingly large if your RSP has grown over all those decades. Here's another real-life example. Let's consider David and Sheila. They're a retired couple from Calgary. They each had RRSPs worth about $800,000 at age 71. When they converted to RRIFs, a mandatory withdrawal rate of 5.28% meant that each had to withdraw over $42,000 in the first year. So that's $84,000 of taxable income on top of their CPP and OAS. Not only did this bump them into a higher tax bracket, but it completely wiped out their OAS benefits for that year. Here's how to avoid it. Withdraw strategically from RSPs in your 60s, even if you don't need the money yet. Smaller, earlier withdrawals can reduce the RSP balance before conversion. Also, use those withdrawals to fund your tax-free savings account or cover lifestyle expenses. Work with a planner to model RRIF withdrawal strategies that minimize long-term taxes. Part 4, tax trap number 3. Taxable investment income surprises. Many retirees hold non-registered investments that generate interest, dividends, or capital gains, but each of these is taxed differently. Interest income is taxed at your full marginal rate. Eligible dividends are more tax efficient, but they still count towards your net income for OAS and other benefits. Capital gains are 50% taxable. Here's another real-life example. Let's take Ken, a 72-year-old in Vancouver, decided to sell an investment property to simplify his finances. The sale triggered a $200,000 capital gain, half of which, $100,000, gets added to his taxable income. That extra income pushed Ken into the highest tax bracket for that year and resulted in a full old age security clawback the following year. So here's how to avoid it. Consider tax-efficient investments like Canadian dividend-paying stocks or corporate class mutual funds. Use TFSAs for growth, as withdrawals are tax-free. Plan the timing of asset sales very carefully, spreading them out over multiple years. That can reduce the tax hit. Part 5, why planning ahead matters. Biggest mistake I see is waiting far too long to address all of these issues. Tax efficiency isn't about what happens in 1 year. It's about how you structure your income over decades. Small, proactive steps like preemptive RRSP withdrawals or shifting investments into TFSAs can save thousands in taxes and preserve your government benefits. The earlier you start, the more flexibility you have to avoid these traps. Now, here's what I want you to take away from all of this, okay? Retirement is not just about how much you've saved. It's about how you use those savings in the most tax-efficient way possible. And the truth is, these hidden tax traps don't just affect high net worth Canadians. They can impact anyone who has spent years diligently contributing to RRSPs, building investment portfolios, and counting on those government benefits like CPP and OAS. The good news, with the right planning, you can avoid these traps and enjoy the retirement you've worked so hard for with fewer surprises and more peace of mind. And that's exactly where I can help. If you want to make sure your retirement plan is on track, I offer a free one-on-one consultation where we'll review your current retirement income plan and withdrawal strategy, identify potential risks like government benefit clawbacks and unnecessary tax exposure, and show you how to make your money work as efficiently as possible for a secure, confident future. This isn't a generic checklist or one-size-fits-all advice. It's a chance to sit down with a professional who can help you navigate Canada's complex retirement landscape and create a plan that's tailored just for you. So click the link below to book your free consultation. Let's make sure you retire with clarity, confidence, and more control over your taxes. If you found this video helpful, don't forget to hit the like button, subscribe for more retirement insights tailored to Canadians, and leave a comment below with your questions. I personally read every single one. Thanks for watching, and I'll see you in the next video.